What's up, guys? My name is P, and I'd like to welcome you to another edition of Phipps Tips. In today's episode, we're going to take a look at the overall market. We'll check out its top performers. We'll have a look at the day's biggest winners and its biggest losers. We've only got one news article today, guys, but it's a rather long one. The author claims that central banks will be the one to jumpstart the crypto craze. We'll see what that has to say. And once we are done through with that, guys, we will be checking up on Bitcoin technically through a little bit of technical analysis. All of that and more coming up, guys. Stay tuned. We are on coinmarketcap.com. The market cap currently sitting at $289.3 billion with a 24-hour trading volume of $13 billion and Bitcoin dominance checking in at 39.9%, down just 0.1% from yesterday, guys. Of our top five, we have Bitcoin down just barely 0.08%. Ethereum is up 2.5%. Ripple is down 0.16%. Bitcoin Cash up 0.36%. And EOS down 1.37% on the day. So far, guys, so far. Looks like we're just doing a little bit of sideways consolidation, figuring out what Bitcoin's going to do. What we are going to do is check out who's moving and shaking versus Bitcoin today. Our number one is Huobi token, up 16.5% against Bitcoin. Buybox token up 11.42% against Bitcoin. And those two coins, guys, are exchange tokens, like the utility tokens from exchanges, Buybox and Huobi, both being, sizable exchanges. Scry.info up 6.15% against Bitcoin. Tron up 6% against Bitcoin. And Syscoin up 5.77% on the day. Let's check out our gainers and losers for the day. Our biggest gainers, OTN, or Open Trading Network, up 52.08%. Sphere Air, never heard of it, up 44.11%. FutureX, up 42.94%. Aventus, up 38.58%. And Rubycoin, up 36.39% on the day, guys. Our biggest losers of the day, we have Fargo Coin down 50.78%. Merc, M-I-R-Q, down 35.55%. Banca, down 28.63%. Pundi X, down 27.14%. I'm assuming this was the dump after it was stated that Pundi X is maybe getting listed on Binance. We don't know. Electronic PK chain down 25.47% on the day. So there are your gainers and losers for the day, guys. We're going to go ahead and get on into this rather lengthy bit of news. So just stay right there. Our news article of the day, guys, brought to you by CoinDesk. Central banks will jumpstart the decentralization of money. Whether Bitcoin or its imitators eventually achieve global ubiquity, they have already achieved success in one fundamental way, forcing humans to rethink their relationship with money and banks. Cryptocurrencies weren't on the ballot during Switzerland's sovereign money referendum last weekend, in which Swiss citizens rejected by a ratio of 3-1 a proposal to end fractional reserve banking and give sole money creation authority to the Swiss National Bank. But they were the elephant in the room. The very presence of the crypto alternative, I believe, will eventually force economies worldwide to disintermediate banks from money. Yet the direct authors of that change won't be activist voters wielding ill-conceived referenda or crypto enthusiasts voting with their wallets. The first phase of transition toward a true money of the people will be implemented by central banks themselves, striving and competing to remain relevant in a post-crisis, post-trust, digitally connected global economy. That might disappoint adherents of the cypherpunk dream who birthed Bitcoin, but the good news for those who want governments out of money altogether is that when currencies become digital and enjoy all the bells and whistles of programmable money, they will foster more intense global competition among themselves. When smart contracts can manage exchange rate volatility, for example, people and businesses involved in international trade will not need to rely solely on the dollar as the cross-border currency of choice. This more competitive environment will ultimately open the door to non-government digital alternatives such as Bitcoin. The backlash against CBDCs, to be sure, official enthusiasm for central bank issued digital currency, or CBDC as it has become known, has waned somewhat as the old guard of central banking has dug in its heels. At the Bank of England, which spearheaded research into the idea 3 years ago, Governor Mark Carney has lately warned of financial instability in his institution were to directly provide digital wallet to ordinary citizens, a change that would in effect give everyone the same right to hold reserves at the central bank as regulated commercial banks. The Bank of International Settlements, a kind of international club for central banks, has echoed Carney's concerns, as have other officials. This backlash, which suggests that the bank's supervisory teams within central bank bureaucracies have regained ascendancy over technologists and innovators in their internal debates over CBDC, stems from a well-founded expectation bank runs would be a real possibility. Why hold your money at risky, friction-laden institutions paying near zero interest when you can store at zero risk with the central bank itself and trade it automatically with other fiat digital wallet holders? But why also should we care what happens to banks? Because banks are the problem. The only reason to promote digital fiat currencies is precisely to bypass the banks. Whether the currency is fiat or decentralized, banks are the problem. The technical, social, and regulatory infrastructure upon which they operate is decades old and fraught with unnecessary compliance costs. Banks maintain centralized, non-interoperable databases on outdated, clunky COBOL mainframes. They rely on multiple intermediaries to process payments, each managing their own siloed ledgers that must be reconciled against each other through time-consuming fraud prevention mechanisms. All of these inefficient systems, instituted to address the problem of trust, merely add to the cost of the trust in the system. Why, in a digital age, can't we move money around 24/7? Because we have bad middleware, and that bad middleware is existing financial infrastructure, which is building blockchain-based trading infrastructures for financial systems. In addition, there's the massive political risk that comes with banks' involvement in our payment system. The reason why it is deemed necessary for governments to bail out the world's banks to the tune of trillions of dollars in 2008 was that not doing so would have thrust our highly complex payment system into chaos. The global economy would have had a cardiac arrest. It's that threat of bringing us all down with them that gives the too-big-to-fail banks a hold over policymaking. Many central bankers, still smarting from the fallout from that crisis, know this is the problem. Many see real benefits in removing banks from payments and recognize that digital currencies can help. The question is how to get there without fermenting chaos. There are gradual solutions. One solution, a phased approach over time. You don't provide CBDC to everyone at first. You start with large non-bank financial institutions, follow it up with a certain class of large corporations, then move to smaller businesses and only make it available to individuals as a last step. Another solution, the introduction of a unique central bank determined CBDC interest rate. This would be in addition to the central bank toolkit for managing money supply, which currently hinges on a combination of a policy rate imposed on banks' reserves and interventions in the two-way market for buying and selling government securities with banks. A separate CBDC interest rate would provide a means to calibrate the flow of money between banks and digital fiat wallets, potentially within a long-term plan to gradually shift it from former to the latter without overly disrupting the system. As Sheila Bair, the former chair of the Federal Deposit Insurance Corporation, argued in a recent op, this new interest rate tool could enhance monetary policy, as central banks could use it to either stimulate or cool the economy. By directly affecting the rate at which people's currency holdings grow, incentives to save or spend could be directly implemented. Still, the author doesn't see developed world central banks rushing to do this. Their relationship to commercial banks are too entrenched. And, for now at least, it's hard for many in that system to even conceive a monetary system that doesn't revolve around them. But it's different for developing world central banks. For too long, those countries' monetary policies have been driven by the policies of the world's biggest central bank, the Federal Reserve. If the Fed cuts rates, foreign inflationary money floods into their bank-centric financial system. If it hikes rates, they face deflationary risk. In theory, a fiat digital currency could allow them to offset those forces. Now, of course, all of this could go wrong. A new tool for profligate governments to debase their citizens' money does not look desirable. For proof, look no further than the rogue state of Venezuela and its new currency controlled by the government, Petro. Yet, they may also be what ultimately gives Bitcoin or some other viable altcoin a chance to shine, especially as Layer 2 solutions start to help with scalability and liquidity. And Layer 2 solutions, guys, that is like your Lightning Network and your SegWits, that sort of thing. Central banks can't put the cryptocurrency genie back in the bottle. Their potential embrace of digital fiat currencies will happen in an era when their citizens have a choice. They can shift to these new decentralized solutions with increasing ease. Whether they take over the world or not, the power of the market in a more open system of currency choice will mean that cryptocurrencies will hopefully play a vital role in forcing these politicized, centralized institutions to better manage their people's money. So what do you think, guys? From what this author, Michael J. Casey, has to say, he seems to think that central banks will be the catalyst that starts the decentralization of money. Now, whether it is because, they're hoping to, be the best and offer the best, currency, the one that's got the best interest rates, the lowest transaction fees, that sort of thing, or is it going to be that the central banks bring all of this, centralized money down, just crashing down, and the only thing left to do is to have a decentralized currency? That, from what I'm gathering from this article, is the two options. Either a bank who's wanting to, be the number one bank offers this sort of money for the people, or it's going to be banks that they're vying for the power, vying, and suddenly it's just a huge monetary crisis, and all the banks just bring the system of money down, and the only thing we can do is have programmable money. In my opinion, I think the latter is probably going to not be what happens. I think that, a main bank will finally see the light, so to speak, and they will be the one to offer the cryptocurrency that will be, the world money. I honestly, I don't believe it will be Bitcoin because number one, it's controlled by, you know, just a handful of people. And by handful, guys, I mean like 50% of Bitcoin is controlled by 4 men, 4 Chinese men. And I really don't see, the world handing over all of this power to the Chinese. I don't see that happening. I mean, I could be wrong. I've been wrong before. It wouldn't surprise me if I'm wrong again, but this is just my opinion. I don't see the world of cryptocurrency falling into tow with Bitcoin. Bitcoin right now is just the biggest because it's the one that's everybody's talking about because it's got the highest market cap. Once the bigger, better Bitcoin comes along, you can bet that the Bitcoin that we know and so love today is going to die. I mean, I've heard stories, oh, Bitcoin's been dead for 300 times now. But it hasn't faced a true death yet, guys. It hasn't, and the reason is because there hasn't been another crypto to knock it off its throne. Once that happens, then you will see the true death of Bitcoin. But drop me a comment down in the comment section, guys. Let me know what you think. Do you think that banks are going to be, on board and, they're going to be the reason, well, they will be the reason one way or the other that we embrace a cryptocurrency as, the world fiat? Will it be because the banks bring about this whole bit of, for lack of a better term, Armageddon of fiat? Or will it be because one bank finally sees the light and offers what should have been offered a long time ago? I'd love to hear your guys' thoughts about it. So drop me a comment or two down in the comment section, guys. Let me know what you think. Do you think that it's going to be, either the people's money, or is it going to be that banks, in their feverish way to stay on top, bring about, total financial collapse? Let me know what you think, guys. And here we are, guys, on the Bitcoin versus US dollar 4-hour scale using the Bitfinex exchange information. Now, guys, yesterday we saw like our big green candle that indicated like the big move, and we brought up our exponential moving average, our 50-hour exponential moving average, and our volume indicator. And that's what we've been using to try to determine what's going to happen with Bitcoin. Currently, guys, what we see happening with Bitcoin is that the 50-hour moving average is acting as a line of support for Bitcoin. If I zoom in here a little more so you guys can see, like the candle, like the wicks on these candles, they meet the 50-hour, but then they just get rejected right back off of it. I shouldn't say rejected, they get bounced. They get bounced off of the 50-hour. But as we can see, guys, I'm going to zoom out here. From here, dude, we've got so much resistance. So much resistance, guys, to try to push through. I'm going to grab a box here and I'll show you what I'm talking about. Like this whole area through here, actually there's all kinds of space. All of this, guys, will act as resistance for Bitcoin. All of this. Because, as I've stated before, and I will continue to state, once we have met or fell through lines of support, those lines of support immediately become lines of resistance. So, and as you can see, we've got all this price action all through here, all through the month of March, early February, or I'm sorry, that's early March still, on into April, and then here in May, we've got all this price action down through here. So yeah, we've got Bitcoin sitting currently on the 50-hour, a little bit above the 50-hour, but it's having a hard time punching because of all this, resistance. It's going to take quite a bit of volume, guys, and positive buying to actually see this price punch through all of this. It's really got to make like $1,000 leap to be, and that's not even safe, guys. That's just to, get back up here into like the 7,700 range. But currently, guys, what we are doing with Bitcoin is we are making another bull flag. We'll put up our trend line here. We'll just use that as the flagpole, like so. And you can see, like, we're just making flag after flag after flag, which is a good sign. I mean, we want to see these bullish patterns, and these are bullish. So what we can expect technically is once this flag plays out, we should, technically speaking, see another price hike. Now, will it make it through all of this resistance? That is the question. That is the question, guys. What we can hope to see, we'll grab another indicator here, guys. I'm going to grab another exponential moving average, and we're going to label this as the 200-hour exponential moving average, and we'll see where that's at. We're going to fatten up that line so we can see it really well. I'm going to change its color to orange, and I'm going to set its input for the 200-hour, like so. And once we hit OK, everything will change. And as you can see, guys, like the 200-hour is way up here in the resistance area. So what we will have to see, guys, for this to, be a legitimate, rebound, I guess, is we're going to have to see Bitcoin push through all of this, push through that, get back up here, and then just stay. Just run sideways, or at least continue up. This is what we'll have to see, guys. We will have to see that happen. If not, what we can expect is just another drop in price. Now, like I stated before, this is a bullish pattern, though. This flag here, this bull flag. So yeah, like once this pattern completes, we should technically see a hike in price. But as I stated before, guys, we are constantly being manipulated here in Bitcoin, so it's just something to keep your eyes on. And the 200-hour moving average currently sitting at like 7,300 some odd dollars. That's where the 200-hour is. That's where we'll have to see. And if Bitcoin does penetrate that, it will be a nice bit of support. If we do happen to retest it, that will be a good line of support, the 200-hour moving average. Historically, it has always been a good line of support. But like I've said, guys, we are constantly on a wait and see approach when it comes to Bitcoin. So, that's just something to keep your eyes on, guys. That's going to do it for the video today. If you're still with me after all this time, hit that subscribe button as I try to post a video every single day, Monday through Friday. If you learned anything new, hit that like button, guys, and share it with your friends. Your friends like free information, and that's what I try to do every single day, is bring you the best information I can for absolutely free. But as always, guys, I'd like to thank you very much for watching, and I'll see you in the next one. Peace.